I started investing when I was 11. I just dithered away until when I was 7 or 8, 9, but so, unfortunately, I didn't get started till I was 11. But I bought my first stock when I was 11. And then I experimented with a whole bunch of things. Like the timing of stocks and charting and doing all these crazy things. It was a lot of fun, profitless, but a lot of fun. And I did that until I was 19. And I read all the books on investing in the public library, and I ate it up. It was fascinating to me, but I had no framework. I was just searching for something. I was hoping that little things on a chart would tell me something about what a stock was going to do. It was kind of crazy, but everybody else was doing it. So I figured I'd do it too sometimes. You turn the chart upside down, it still wouldn't help. Then in 1949, I read The Intelligent Investor by Ben Graham. I'd never heard of them up until then, and there are really only 2 chapters in that book that are the key to it. But they set my philosophical framework for investing in 3 ways. They're so basic and so simple it's hard to understand how they could be that important, but the 10 commandments are simple. The first is that a stock is part of a business. You can't think of a stock as something different. It's you value a business, and then you divide it by the shares outstanding, but what you have to think about is what kind of a business. Are you getting into what are its economic characteristics for its competitors? What's its management like? All of these things that relate to a business instead of a little ticker symbol. I used to know when I was 11 or 12 the ticker symbols of every company virtually on the New York Stock Exchange. I could mark the boards of Harris up them, but I didn't know anything. I knew that X was U steel, and 2 was at T, and so on, but I didn't know anything. I didn't know what was behind them, so I had to start looking at these little symbols, or these little names in the paper as businesses and decide. How do you value a business? What counts? The second thing in the book is that Graham gives you a marvelous set point in terms of how the investor should react to stock market fluctuations. He talks about his mythical Mr. Market in Chapter 8. There's been no better thing written in terms of the investor's attitude towards stock prices. Most people react the wrong way to stock prices. They feel good when their stocks go up. They feel bad when they go down. They think the stock market is there to instruct them, and Mr. Market is this partner you have in investing. He's a remarkably obliging partner. This guy comes around every day, and he tells you what he'll pay you for your interest in the business or what he'll sell you more at the same price. Nobody ever does that in private business. If you and I own a gas station together, and I said every day, I want you to come in and offer me your half interest in the station, and I can either buy your half or sell you my half at the same price, and you have to come in every day and do it. You'd be at a terrible disadvantage, and you'd be at a particular disadvantage if you're Mr. Market in the market, because Mr. Market or a friend of the market who obligingly gives you those figures every day, different figures at the end of the day, at the start of the day. But he's naming a price at which you'll either buy or sell. The beautiful thing about him is that this guy is an alcoholic manic depressive. He is as unsound as they come. He wanders around all day, and looks at the crazy things, and knows he's going to name all kinds of crazy prices, and you don't have to pay any attention to them except when it's to your advantage to do so. If that's once a year, if it's once every 5 years, it's 1 stock out of 3,000. All you have to do is sit there. There you have no moral responsibility to this jerk, He is naming these numbers. You didn't ask him to. But he's doing it, and all you have to do is pick the one time when he is particularly depressed, or particularly manic, or particularly drunk, or whatever. It may be in the market will be all of those things, and you take advantage of it. And that's what's remarkable about stocks. If you think about it, is that if you look at the highs and lows of all of these American companies for the last year, you'll see case after case after case where the high is twice below now. That's for sound American businesses running along, paying people, selling goods. And so on. If you go out and look at farmland 10 miles from here, there's no way in the world over here that the farmland is going to range in value from X to 2X. It doesn't maybe go from X to 110 of X or vice versa. If you look at an apartment house near here and figures on essentially apartment houses like that over a year, it won't move 10 in a given year. But here are the finest of American businesses and people. Just name these numbers that go all over the place. And you don't have to play except when you want to. That's the important thing, and that's the that's. What Graham tells you is the market isn't there to instruct you to tell you anything. The market is there just basically to serve you. When you want it to serve you. You know, one of the most important things to remember in stocks is very hard to do, but people have all these feelings about it. The stock doesn't know you own it. You know you're sitting there with these certificates for Berkshire. The company doesn't even know you own it, you know, and the stock doesn't. It's trading now. And they don't know you own it, so it has no feelings about you. I mean, you got all these feelings about it. But it's just part of a business. If Berkshire is worth 75,000 times 1.5 million shares, you know, roughly 110 billion. Or something like that. It's a good investment. If it isn't, it's a lousy investment, you know. You have to value the business, and Graham, you know it's amazing, but people don't do that in Wall Street, you bet. You hear price targets, or that kind of thing, but you see no one write a paper that says, here is the nature of this business over the next 20 years. Do you know what will that it should that business sell for? Forget about what it's selling for. In fact, one of the things. I just can't get rid of one leg of the three-legged stool and still have a good investment philosophy. But I would say that the most important thing over a long period and working with big money is to understand the business. Let's just say for the moment that you were given $1 million or whatever was necessary, and you could look around Knoxville or look around all of Tennessee. If you want to buy into any three businesses, you know between now and a week from now, private businesses are not trading or anything of the sort. You've got a week to do it, or you have to give the money back. What will you be doing during the next week? I mean, you can look at all these companies. Some of them, you're quite familiar with. Some of them, you're less familiar with. You know by reputation. Some of them, you know the management. Some of them, you know their competitive situation. What will you be thinking about during that 7-day period? How will you actually be screening these companies out? I think you look for 3 businesses, and you can't trade them after you buy them. You're gonna own the rest of your life. You're gonna be looking for businesses that have an enduring competitive advantage. You don't want to buy a Burger King franchise just because nobody's come within 10 miles of it yet. Because you know Wendy's and Donald's, and all of those will be there pretty soon. It isn't necessarily who's earning the most money now. You're going to look for something with an enduring competitive advantage. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to my channel before you go.